Welcome to The Capitalist Compass, the podcast that decodes the free market to help you live a prosperous and independent life. If you're ready, let's dive in.
Welcome to the deep dive.
Mm.
Okay, let's unpack this. What really makes something valuable? It's a huge question. Today, we're diving into that, especially looking at something like Bitcoin. The goal, to get properly informed, beyond just the headlines.
Absolutely. And what's fascinating, I think, is how much our own human perception plays into it. It really shapes our financial choices, why we even look for value in the first place. We'll kind of unravel how we use money and that basic hunt for something lasting.
Right. So we all use money day to day, obviously, but thinking longer term,
Yeah,
saving, investing, are they really that different? People seem to mix them up.
they do. And it's a really crucial difference. Like, just saving cash often isn't enough. Inflation chips away at it, right? So you're actually losing buying power. The real aim becomes keeping, or ideally increasing its value. So invest in it. That's putting money into assets you hope will generate income or go up in value.
And that takes work.
A lot of work. It demands time, real knowledge. Think about, serious stock investors reading endless financial reports. There's that statistic, isn't there? Historically, maybe only 5% really make consistent profits in stocks. It shows that money working for us, it's mostly us having to work alongside our money.
Okay, so that's investment active. Requires know-how.
Yeah.
So saving must be simpler.
Yeah.
More about just holding steady.
Exactly. Saving is more about exchanging money for assets just to preserve value. It generally needs less intense homework, like bank deposits maybe, when things feel stable. The main goal is just holding on to what you've got.
So if we want to preserve value, but maybe without becoming a full-time analyst, what makes an asset, resilient? What are the key things?
Well, for assets that are meant to really hold value over time, there are two big ones: scarcity and durability. Scarcity means it's genuinely limited, hard to make more of. And durability, well, it just has to last. It can't easily break down or degrade.
Like gold.
Gold is the classic example, yeah. It's naturally scarce. Mining it is incredibly difficult, expensive, huge amounts of capital, time, labor, and it's famously durable. It doesn't rust, doesn't really corrode. Sure, you could theoretically make gold in a lab, but right now it would cost something like $2 quadrillion an ounce, so not really a concern.
So that scarcity has to be real, not just like a label someone slap on it.
Precisely. Think about some limited edition collectible. Its rarity is kind of fragile, isn't it? If someone else figures out how to make perfect copies easily.
Poof, the scarcity is gone.
Overnight, yeah.
Okay, this is making sense. So here's where it gets really interesting. Bitcoin. It's digital. Humans made it. How do scarcity and durability even apply?
Right, and that's the fascinating part. Bitcoin gets these properties from its underlying code and its network. Its scarcity is literally programmed in. Fixed supply, predictable creation rate, that's it. And interestingly, what protects that scarcity is, human self-interest. Or greed, you could say.
Greed. How does that work?
Well, the people involved, the miners, the holders, they're incentivized not to change the rules in a way that would create more Bitcoin, because doing so would devalue their own holdings. So their self-interest actually locks in the scarcity.
Okay. And durability. It's just information.
It is, but think about where that information lives. Your Bitcoin balance, say you have 100 Bitcoin, isn't in one place. It's recorded on hundreds of thousands of computers all across the globe. Some are even in space, believe it or not. That massive distribution makes it durable, and it's secured by a mix of things.
Let me guess. Self-interest again.
That's part of it, yeah. The incentive to maintain the records accurately, but also really complex mathematical equations that make the records basically impossible to tamper with. And finally, huge amounts of electrical power to make sure everyone agrees on the state of the records without needing, a central bank to verify it. So if you connect this to the bigger picture, some argue these factors, self-interest, math, electricity, are as fundamental, as natural almost, as the geology behind gold. Maybe even stronger, because they grow as more people want Bitcoin.
Wow. Okay. But if the foundations are so strong for things like gold and Bitcoin, why do their prices jump around so much? Why aren't they just stable?
That's a great question, and it really hits on two key things. First, different people see the strength of those value factors differently. Their perception varies. Bitcoin's a perfect example. Think how many people really understood its value proposition 10 years ago versus today. It's vastly different.
Right. Way more people get it now, or at least are aware of it.
Exactly. And that changing understanding drives demand, which impacts price. Still, maybe less than 1% of the world truly gets the deep mechanics of Bitcoin. Compare that to gold, where maybe, over 10% have some understanding. That gap in understanding creates volatility, but also maybe opportunity for those who learn. And the second point, maybe even more important, price is not the same as value.
Okay, explain that one.
Imagine a gold coin costs, say, 100 bet today, and that buys you 10 kilograms of rice. Now, fast forward 10 years, that same gold coin costs 500 bet. But rice now costs 50 bet per kilogram. So the coin costs more bet, its price went up 5 times. But it still buys you exactly 10 kilograms of rice. Its value, its actual purchasing power, stayed the same. See the difference?
Oh, okay. The number changed, but what it can actually get you didn't.
Precisely. The price fluctuates based on market sentiment, speculation, currency changes. But the underlying value tied to those core properties aims to be more constant. So tying this back, for those of you listening who want to preserve wealth but maybe don't have the time or desire to become expert investors, the strategy could be focusing on assets with really strong, hard-to-change value factors, things rooted in something fundamental, like gold with its physical reality, or Bitcoin with its code and network dynamics. Some people might even put things like broad U.S. stock index funds in a similar category, though that's a slightly different argument. The idea is to find assets where you don't have to constantly outsmart the top 5% of professional traders just to hold your ground.
That makes a lot of sense. So what this really means for you, listening, is understanding that core split between investing for growth and saving for preservation, and really getting what scarcity and durability mean. That knowledge can genuinely empower your financial thinking.
Absolutely. And we've really just scratched the surface today. There are so many related questions, like what's the deeper story with bank deposits? How exactly do greed, math, and electricity mesh together for Bitcoin? What about land? Is that a store of value? It's complicated. And does Bitcoin have some purpose beyond just storing wealth? Lots to explore.
Definitely food for thought. So maybe the final thing for you to mull over is this. How does your own understanding, or maybe lack of understanding, of these deep value factors shape how you see wealth? And how might it influence the choices you make to look after your own financial future?